The price of the S&P 500 is literally staring over the edge of the precipice right now, and we're going to see a 10% move in the price, either up or down, over the course of the next month. Which way is it going to go? Welcome to the 12-Minute Trading Market Minute for Monday, the 5th of September. We'll start off with the context of today's question by looking at a weekly chart of the S&P 500. We have to zoom way out and see what's happening to the price before we can zoom in and sort of answer today's question. So since the beginning of the year, we've been in a bear market. This is a series of lower highs and lower lows all the way along here. And it's pretty easy to see that with the lows at about 24.5% this year, this is just another lower high. This might even be a monthly lower high. And it's pretty easy to extrapolate that we're going to be heading for lower lows later on this year, maybe even over the next month. And I've heard a tremendous amount of people talking about the 2008 analog, and due to the magic of social media, because one person which gets popular on a Twitter posts a side-by-side comparison of today's market with 2008, then everybody's talking about the 2008 analog. So let's go back and look at this into 2008, and we can see where we are here. This was kind of this initial move off the bear, down 20%, a rally up to a lower high. This is very similar to what we've seen into the rally into mid-August. And then we've seen that reject since that point down to about this level. It's about the same type of pattern. So everybody's saying, okay, here's where the worst of the selling comes in right around now. So get off today before you really get hurt. So it's hard not to look at something like this and say, gee, the same thing's happening all over again. Lightning is about to strike in the same place, in the very same spot. Okay, now that we've looked at the 2008 analog, now what I want you to do is to go back to 2011. So this is about 11 years ago, where we had a nice bounce off of the 2009 lows, and then we sort of got unstable. And then this is around where Standard & Poor's downgraded the United States debt. And this is a really nasty move, which brought us down 21%. Very similar, right? So we had our bottom test and an undercut. This was great. And a nice rally out of there. Very similar to what we've just gone through into mid-August. And then what happened is the price started to, let's bump this along one day at a time. The price started to sell off. So from this consolidation, everybody was expecting the price to go higher. And instead, what it did was it dropped like a stone. What we had at this point was everybody was just completely sold on the fact that, we are going for a retest of the lows, or probably this is going to end up being a lower high in the monthly chart, and we're going to roll over and retest the lows of 2009, 400 points down from there. So everybody was just completely bearish at this point and thinking that it was over, right? So all this nice little rally, nice effort, but it just created a higher launching point for the bears to the downside. So contrast that with today. Now, what we had to use at this point was fib retracement. So we went into our fib tools and we start at the very bottom of the move and we took it all the way to the top. And then what we can see is that we have very important fib retracements at 38.2. That got run through. 50%, that got run through as well. And here's the last line of defense for the bulls. 61.8% retracement right down here at 1160. Now that had to hold at that time. Otherwise, if we saw close below that level, then we knew with a high degree of certainty that we were going to see at the very least a fill-in of the triangle, which means at least a retest of those early October lows back in 2011. Now, what ended up happening from there was a move that very few people expected. We saw the price bounce off that 61.8% retracement and scream higher. And it took a lot of people by surprise. especially the bears at that time. Now, just about the point when people said, you know what, we actually have a rally in mind here, and this could actually be a good thing, right? So we're recovering. Everything was looking good again. And then what do you think happened? Guess what? One more trip to the downside. And let's go through this again, because this was an important level all the way down here. And what do we need? We needed our fib retracements again. So let's go ahead and move these up. I think I'll just start from scratch here instead of trying to push that one around. Let's go from the bottom all the way to the top. Same thing. And notice how this was a 61.8% retracement all over again. There it was. So this level had to hold. Otherwise, this becomes a massive lower high. This becomes a very, very negative sell signal if this 1200 level did not hold. If we close below that level, then that would encourage the price to go all the way down and undercut this 1160 and more than likely keep on going down below here. So this was a huge tipping point. The price could have gone either way. It certainly could have gone to the downside and it would have fulfilled the fantasies of the bears. What happened instead was the price rallied like crazy and kept on going for quite some time, catching all of those bears off guard and creating a massive short squeeze to the upside. Let's talk about today. Here we are today on Monday the 5th on Labor Day, and the price is where? Well, guess what? We're right at that 61.8% retracement again, and that's been tested. Those lows have been tested over the last couple of days. If we take this from the bottom of the swing, the entire swing, look at where the price has come down to, right? So everybody was happy. We'll go through the same thing as we went through in 2011. Everybody was happy up here going, okay, maybe we're done with a bear. Nice little pullback, and then boom, lower high based on the Fed. The last 6 trading days have been really, really bad. And so it's easy to be very bearish at this point right now and think that it is over. But there's that 61.8% retracement. There is the last line of defense for the bulls. If the price closes below this level in the next day or two, then chances are very, very high we end up undercutting the June lows and we fill in the triangle and we drop below the current low of 24.5% for the year, and we extend the bear market. And quite honestly, the worst of the selling usually gets worse from here. This is just the initial phase of the bear. This could be phase 2, which is that sort of lower high that sets up on the monthly chart. And step 3 or phase 3 of a bear market is where the worst stuff happens. And a lot of people have called for potentially, and let's go back out to the weekly chart. A lot of people have called for potentially an undercut of the pandemic lows, maybe something down here near 2000. And this could get started here with the next wave of the bear like this. So this is definitely on the table, and we're going to know about that if the price undercuts that 61.8% retracement, which is right there at 3,900 on the cash S&Ps. So guys, if we see a closing price, and this means in the last 90 minutes of the day, the price has no intentions of reversing and going back up above that level. And usually we know in the last 90 minutes of the day. So watch 3,900 like a hawk in the closing 90 minutes. If it closes below this level, just like this closed below that level, and it was a clear route to the downside, we'll usually know it. Then get ready with your bear shoes, because it's going to be a bear party for the rest of the year, more than likely. However, if you saw what happened in 2011 and you think that's a possibility, if we start to see the price, first of all, closing maybe above these intermediate levels, like about 4,000, and then closing above some of these individual candles, and then especially closing above 4,200. If we see a close above 4,200, chances are very, very high that we may be starting, and it's not going to be easy. If you recall the example in 2011, we may be starting a short covering move to the upside, which quite frankly, no one is on board this train right now. Everybody wants to be on this train, but nobody will join this train. Everybody at this point is conditioned not to join or not to buy the dip. In the next Market Minute, I'll talk about how we can take advantage of these types of moves, irrespective of which direction that it goes, so we can be agnostic about this and not necessarily get biased into loading up too heavily in one direction or the other. Markets will move in such a direction so as to cause the greatest amount of pain to the largest cross-section of traders. Watch what happens in the next 30 days. That's it for today's Market Minute. Thanks for listening. We'll see you in the next one.